In trading, the name of the game is liquidity, so understanding it can help us be better traders. In this video, we'll go over internal range liquidity and external range liquidity. And after watching it, you'll know exactly how to trade using this concept. Let's begin by defining two key concepts: internal and external range liquidity. Internal range liquidity refers to areas such as fair value gaps, while external range liquidity is found at swing highs or swing lows. How do these two concepts connect? The market has two primary objectives. It either seeks out old highs and lows, or it moves to rebalance a fair value gap. Therefore, when external range liquidity is taken, price is likely to move towards the internal range liquidity. Similarly, once internal range liquidity is met, price typically returns to seek out old highs and lows, or external range liquidity. But hearing the definitions isn't enough, so let's look at this visually so you can understand it. Over here, we're looking at the daily chart of Euro USD. Notice how the market has traded above this old swing high? Now that external range liquidity has been reached, it's likely to retrace back into internal range liquidity. All the way down here, we have a fair value gap that has not yet been traded into. We'll want to wait and keep an eye on this area. After a while, the market is trading at a lower price, and it has tapped into a fair value gap. So based on what we've learned, where is price going to go next? You guessed right. It's going to seek the external range liquidity right here at the swing high. After it's been taken out, we can expect a retracement. Again, it went lower and reacted to the fair value gap. You can see how it keeps repeating this process over and over again in a cyclical nature, but it might look different. Maybe something like this. First, we're going to be using top-down analysis to refine our entry while targeting the higher time frame, external liquidity, for a better RR. Right now we're at the 4-hour time frame on the Euro chart. Here we can see the market is making lower highs and lower lows, and it's trending down. Now you might notice this large fair value gap here that has not yet been traded through. We should first wait for it to retrace back to this area before entering a short position. So after a while, it did end up going back to our fair value gap. But we don't want to just enter a short position based on this. So we're going to zoom into a lower time frame to see exactly what's going on. Let's hop down to the 15-minute. Once you're here, you want to identify if there are potential signs of reversal. So here we see the market ranging for a while before it finally swept swing highs and broke down lower. This is a shift in our market structure, and we'll be looking then for short opportunities. It ended up creating two fair value gaps to the downside. Now, which one should we keep an eye on? To make things easier, we'll use our fib retracement tool to see the premium and discount area. So here we see the upper fair value gap falls within that premium. We can enter or wait for one more break of structure just to be sure. Once we have that, enter on the candle close, setting your stop above the swing high and aiming for external range liquidity lower. Now there's one more way to look at this. Here you'll notice that these equal highs have been taken out by the market. Since external range liquidity has been taken out, the next draw will likely be the internal range liquidity. So here it trades all the way down to our fair value gap. Now that internal range liquidity has been met, so it's likely going for the next swing high. And now it's done just that, going all the way back up, leaving behind new fair value gaps that are again likely to support price to move higher. After a while, we see price creating new structure and doing the same thing again. It's targeting these highs and rebalancing the fair value gaps. We can look to enter a long position on the next retracement, simply aiming for levels higher with a favorable risk to reward ratio. By understanding the relationship between external and internal range liquidity, you're going to have a better idea of where the market is heading next.